Welcome to the deep dive. We're here to cut through all the data, the dense reports, and really pull out the important nuggets of knowledge for you.
Yeah, get straight to the insight.
Exactly. And you've given us these recent financial statements for JAT Holdings PLC. So our mission today, turn these figures into a story that's clear, easy to grasp.
Makes sense.
We're focusing this deep dive on JAT Holdings PLC's financial performance and where they stand right now. Specifically, we're looking at their interim report, the one for the 3 months ending June 30, 2025.
Right, the latest quarterly number.
Yeah. And the big question we're kind of asking is JAT Holdings really seeing sustainable growth here? Or, are there maybe some hidden currents under these pretty impressive numbers?
That's the key question, isn't it?
We want to uncover the trends, the highlights, and those really critical points that matter if you want to be properly informed about this company.
And we've got the source material right here.
We do. For this deep dive, we've really dug into the nitty-gritty, their unaudited interim financial reports.
Which means balance sheets, income statements.
The whole lot.
Yeah.
Cash flows, detailed notes, everything. And just so we're clear for you listening, when we say company, we mean JAT Holdings PLC itself, the main entity.
The parent, basically.
Right. But when we say group, that's JAT plus all its subsidiaries rolled together.
Like the whole family. Sometimes they tell slightly different stories, so it's good to keep that distinction in mind.
We'll definitely point that out if it matters. Okay, so let's kick things off, the big picture first. How did JAT Holdings actually do financially this quarter?
Where do we start? Profitability.
Yeah, let's look at the profitability snapshot. The group's profit, it saw a pretty significant jump, up 20%, hitting nearly 150 million rupees.
And that's compared to about 124 million in the same period last year.
Exactly. And the company itself wasn't far behind either. It was up 7%, reaching over 165 million rupees. So, a strong start on the surface.
It absolutely is. And what really jumps out at me here isn't just that they're making more profit.
Yeah. What else?
Well, it seems like JAT might be decoupling its profitability from just pure revenue growth in some ways. Look at the gross profit.
Yeah.
Group gross profit surged 26%, and the company's jumped an even more impressive 39%.
Wow, okay. 39%.
Yeah. And then look at the results from operating activities. That's the money from their core business before interest and taxes. That rose a hefty 54% for the group.
54.
And 59% for the company. That suggests, maybe a really aggressive focus on controlling costs or perhaps a shift in what they're selling, their product mix. Something's boosting that bottom line more efficiently.
That's a great point. It adds a lot more depth than just saying profit went up.
Exactly. It's a more subtle, maybe more powerful story than just the headline profit number.
Okay, that context is really helpful. It makes these numbers much more meaningful. Now, let's maybe shift gears a bit and dissect that income statement, see where the money came from and where it went.
All right. Revenue sources.
Yeah. Looking at the geographical revenue. Sri Lanka. Clearly a powerhouse for them.
Still the core market, it seems.
Definitely. Group revenue from Sri Lanka grew 13% to over 1.69 billion rupees. And the company's revenue was up 15%, hitting over 1.63 billion.
Solid growth there. But what about other regions?
Yeah, that's where it gets a bit mixed. We do see a dip in Bangladesh revenue for the group. It's down 16% to about 525 million.
Okay. A pullback in Bangladesh.
And then there's this interesting kind of contradictory picture in India, Maldives, and other countries.
How so?
Well, the group's revenue from these places is down 37% to just under 50 million rupees. But get this, the company's revenue there is up a massive 90%.
90%. Whoa, up to over 34 million.
Right. So why would we see such a big difference between the group figure and the company figure for those specific regions? What could be driving that?
Yeah, that's a sharp observation. The statements don't spell it out exactly, but often a discrepancy like that points to how the different parts of the group are structured. Or maybe where their direct sales channels are versus the sales through consolidated subsidiaries. For instance, maybe the company itself, JAT Holdings PLC, landed a big direct contract in India or the Maldives.
While a subsidiary operating there struggled.
Exactly. That could explain it. It's definitely something you'd want to look for more detail on in, say, the annual report later.
That makes sense. A structural thing, possibly. Okay, now digging deeper in that income statement, one line item just leaps out.
Which one's that?
This incredible surge in other income.
Oh, yeah, I saw that. Quite something.
Isn't it? For the group, other income just skyrocketed, 671% up to nearly 62 million rupees, from only $8 million last year.
671%. Wow.
And the company's other income also saw a huge jump, up 239% to almost $21 million. What are we supposed to make of that?
Well, this definitely raises an important question, right? What's driving such a sharp increase? The specifics aren't broken down here, but such a jump usually signals gains from non-core activities.
But not their main business.
Probably not. It could be anything, really. Maybe they sold off an unused asset, like some land or equipment, or perhaps a one-off, really favorable foreign exchange gain, certain investment returns, maybe.
So a bit of a wild card.
Kind of, but whatever the source, this surge had a significant positive impact on the profit for the period. It really helped boost that overall profitability we talked about earlier.
Okay.
But it's likely more of a one-off boost, not something you'd necessarily bank on seeing every quarter from their core operations.
Got it. So good for this quarter, but maybe you don't assume it repeats. And what about the money going out, the expenses?
Right. Costs are always key.
We see increases in selling and distribution expenses. They're up 37% for the group and 53% for the company.
53% for the company, that's quite a jump in sales costs.
And administrative expenses also rose, 20% for the group, 22% for the company.
Yeah, those increases are definitely noteworthy. Maybe not totally surprising if they're pushing for growth, but still significant increases.
And then there's the finance side of things.
Costs and income, yeah. How did that look?
Well, the group's finance cost, basically what they pay on their debt, that increased by 40%. Over 104 million rupees.
40% increase in borrowing costs. Ouch!
Seems it was mainly driven by interest on loans and borrowings, plus some foreign exchange loss.
Okay, that makes sense. Debt getting more expensive.
Oh, but then, on the flip side, group finance income, the money they earn from investments, that actually decreased by 22%, down to about 51 million.
Huh. So borrowing costs up, investment income down for the group.
Yeah, although interestingly, the company's finance income actually saw a small 4% increase.
Okay, another little difference between group and company. So what do these finance trends suggest overall? Higher debt costs, maybe fluctuating investment returns for the group.
Yeah, what does that imply?
It implies potential pressure on their net income, right? Even if their operations are strong, rising finance costs and lower finance income can definitely squeeze the final profit number. It points towards maybe higher leverage or less effective returns on their cash holdings for the group level.
Right, something to watch. Okay, moving on from the income statement. Let's pivot to the balance sheet.
The snapshot in time, June 30th versus March 31st, 2025.
Exactly, what the company owns and owes. So, looking at assets first, we see a slight decrease, actually, in total assets for both the group and the company over the quarter.
How slight?
For the group, it went from roughly 16 billion rupees down to 15.9 billion. So not huge, but a decrease.
Okay. What about the components? Current assets.
Yeah, some interesting moves there. A significant increase in inventories for the group. Jumped from around 2.8 billion up to 3.3 billion rupees.
Building up stock, then.
Seems like it. But at the same time, there's a notable decrease in trade and other receivables for the group.
Yep.
That fell from 4.9 billion down to 4 billion.
Okay, so inventory up, money owed by customers down. Interesting combo.
Yeah. And they're ready cash.
Yeah.
Cash and cash equivalents for the group also decreased from about 320 million down to 253 million.
Right. If we connect this to the bigger picture, these shifts tell us quite a bit about liquidity and the company's financial structure.
How so?
Well, that increase in inventory, combined with the decrease in receivables, it suggests a few possible things. Either, like you said, they're building up stock because they expect higher demand soon, or maybe they're just selling their existing stock more efficiently and getting better at collecting their debts faster, which would generally be good for cash flow.
Okay, that makes sense.
But that decrease in cash itself means that while operations might be humming along, some of that cash is getting tied up, maybe in that extra inventory or being used elsewhere. This mix really influences their working capital.
Working capital, that's like the day-to-day cash they need to run things.
Exactly. Think of it like your household budget. Are you getting paid quickly, and are you managing your spending on groceries and bills efficiently? That's kind of what working capital reflects for a company.
That's a really good analogy. Makes it clear.
Yeah.
Okay, so that's the asset side. What about what the company owes? Liabilities and equity.
The other side of the coin.
We see total equity for the group growing from about 10.3 billion up to 10.6 billion rupees.
That's a positive sign. Equity growing is generally good.
Yeah, the report says it's partly driven by issuing new shares, which we'll get to, and also retained earnings from profits.
Okay, so funded by capital raises and profitability. Makes sense.
And on the liability side, we see a decrease in current liabilities for the group, down from $5.4 billion to about $5 billion.
Lower short-term debts.
Seems so, particularly in trade and other payables money. They owe suppliers and bank overdrafts. Both went down.
Okay, so what do these changes, equity up, current liabilities down, signal about JAT's overall financial structure?
What's the interpretation?
It's a very important observation, actually.
Yeah.
The growth in total equity, especially because it came from new shares and profits, tells us the company is strengthening its financial base. It's building value.
Right.
And the decrease in current liabilities, especially things like bank overdrafts, suggests they're managing their short-term debts better, maybe reducing their immediate financial pressures.
So getting healthier financially.
This combination definitely points towards a healthier, more stable financial structure. And that's really crucial if you're aiming for long-term sustainable growth.
Okay, so the balance sheet story seems broadly positive then. Healthier structure.
Seems that way based on these figures.
So what does this all mean for the actual movement of money? Let's turn to the cash flow statement. This really tells the story, doesn't it? Where cash is actually coming from and going.
Yeah, cash is king, as they say. How did operations look?
Well, net cash from operating activities remained positive for the group, almost 127 million rupees.
Okay, so the core business is generating cash.
It is, though it did decrease a bit from last year's 142 million. So slightly less cash from operations this time around.
Okay. Still positive, but a bit lower. What about investing?
That's where we see a big change. A significant increase in net cash used in investing activities for the group.
So spending more on investments.
Yeah, it jumped from about 102 million used last year to over 198 million used this year.
Doubled almost. Where did that cash go?
Notably, purchases of property, plant, and equipment, about 101 million. And also substantial investments into fixed deposits and money market funds, around 236 million there.
Okay, so investing in both physical assets and financial assets. Interesting.
And then the financing side. This saw a truly significant shift.
How so?
Net cash from financing activities for the group. It went from being a net outflow last year, about 110 million going out, to a massive net inflow this year. Almost 370 million rupees coming in.
Wow, quite the turnaround. From cash out to significant cash in? What drove that?
The main drivers seem to be proceeds from interest-bearing loans and borrowings. That brought in nearly 2.9 billion rupees for the group.
Okay, taking on substantial new debt then.
Seems so. And importantly, there were also proceeds from exercising employee share options, or maybe just issuing new shares. That generated over 122 million for both the group and the company.
The share issue we saw reflected in equity.
So putting that all together, operations bringing in cash, but less than last year. Much more cash going out for investments and a lot more cash coming in from financing, especially loans and that share issue.
Yeah, and a crucial insight from this cash flow statement is really the story it tells about strategic capital deployment. Meaning, while their core operations did generate cash, they also dramatically increased their investing. Looks like expansion or maybe strategic asset buying.
Right.
But the really interesting part is how they covered that increased investment spending. It was through new financing, particularly those big new loans and that share issue.
So borrowing and issuing stock to fund growth.
Exactly. It shows a company actively raising funds to fuel its growth plans and expand its asset base, rather than just relying purely on the cash generated from selling its products day to day.
It paints a picture of ambition, maybe.
It does. Think of it this way. The cash flow statement shows they're not just earning money, they're acting like a confident entrepreneur, taking out new loans and issuing shares to expand, rather than someone just, scraping by on operational cash alone.
That paints a very clear picture indeed. Okay, let's move beyond the core numbers now. Let's dive into the notes section. That's where you often find deeper corporate insights, shareholder info.
The fine print, yeah. Sometimes the most revealing part.
Definitely. First, just to quickly reiterate for everyone listening, JAT Holdings PLC is a public limited company incorporated in Sri Lanka, and it's listed on the Colombo Stock Exchange. Basic stuff, but important context.
Got it.
Now, looking at the shareholding structure, the list of the 20 largest shareholders, it shows that one individual, Mr. A.W. Gunawardene, holds a really significant majority stake, 64.55% of the shares.
Wow, okay. Over 64%, that's substantial control.
It is, and the director shareholding section also shows that key management has a direct stake in the company too, which you generally like to see. Alignment of interests.
True, that's usually seen as positive. But that high concentration of ownership,
Leads to something else.
it does. This raises a really important question about compliance, and it's a critical point for the company right now. The notes clearly state that the company has not complied with the minimum public holding requirement.
Ah, the stock exchange rules.
Exactly, under the listing rules of the Colombo Stock Exchange. As of June 30th, their public holding the shares held by the general public was only 19.014%.
And that's too low.
Yes, it falls short of the required threshold. For companies under the specific rule, they fall under option 4, I believe it was. This is actually a significant regulatory challenge for them.
Why is it so significant? What happens?
Well, noncompliance can lead to various penalties from the exchange. Fines, potentially restrictions, and in worst-case scenarios, even suspension or delisting. Plus, there's the reputational damage. It's definitely something JAT Holdings needs to address, and probably quite proactively.
You've really hit on a crucial regulatory detail there. So, what could be the direct implications for JAT if they don't sort this public holding issue out quickly?
Well, like I said, there's the immediate regulatory heat, but beyond that, it can really impact investor confidence. If a stock isn't widely held, its liquidity can suffer.
Meaning it's harder to buy and sell shares.
Exactly, which investors don't like. It could also potentially hinder their ability to raise more capital on the exchange in the future if they're seen as non-compliant. It's this tricky balance they need to find between maintaining control, which that large shareholder clearly has, and ensuring enough shares are out there for market accessibility and to meet the rules.
Right. They clearly need to reevaluate that balance. Definitely something for investors and potential investors to keep a close eye on.
Absolutely. It's a key risk factor right now.
Okay. Now, on more positive note, maybe circling back to that share issue, the company did issue new shares during the quarter ending June 30th.
The ones that brought in cash.
Yeah, over 4.5 million ordinary shares were issued at 27 rupees per share. That raised gross proceeds of over 122 million rupees.
Which we saw reflected in the cash flow and the equity section of the balance sheet.
Exactly. It increased their stated capital and the total number of shares out there. And also for anyone who was tracking their initial public offering, their IPO.
From a while back.
Yeah, it's maybe good news to hear that, according to the notes, all the projects they planned using those IPO funds have now been executed.
Okay, so they followed through on their IPO promises, it seems. That's good.
Seems so.
Oh.
Just quickly touching on market activity for the quarter. The last traded price for the share was 27 rupees. The highest it hit was 30, and the lowest was 25 rupees.
So trading in a relatively tight range that quarter.
Yeah. And finally, a couple of other points from the notes. The company has some corporate guarantees out there given to banks, specifically about 486 million rupees to Commercial Bank of Ceylon and Hatton National Bank.
Guaranteeing someone else's debt. Or perhaps subsidiary debt.
It doesn't specify. But the directors state they don't expect any liabilities to actually arise from these guarantees. Standard disclaimer, perhaps.
Usually is, but still worth noting.
And speaking of the future, the directors have affirmed the company's ability to continue as a going concern for the foreseeable future. They state they have adequate resources, which is, standard language, but always an important reassurance to see.
The going concern statement, yes. Essential boilerplate.
So, okay, let's try and synthesize this deep dive then. What have we seen? We've looked at JAT Holdings PLC, and it seems to be a company demonstrating, well, pretty strong operational profitability, right?
Yeah, definitely growth in profit, especially operating profit.
Growth in certain segments, making some significant investments.
Yeah, big jump in investing activities.
And strategically using new financing, those loans and the share issue, to fuel that. It really looks like they're actively trying to expand.
Precisely. They appear to be in a clear growth phase, actively raising and deploying capital. However,
There's always a however.
there often is. Alongside this operational momentum and growth story, we've uncovered that notable regulatory compliance issue, that public shareholding shortfall.
Right. The elephant in the room, maybe.
It's a key area they absolutely have to address, and it could significantly impact their future depending on how they handle it and how the regulators respond.
Absolutely. Which leads us to our final thought for you, the listener. Given this clear operational momentum at JAT and their strategic use of financing to really fuel those investments, how might they navigate these growth ambitions while also addressing that pressing need to meet the public holding requirements?
Yeah, how do they square that circle? Keep growing, maybe keep control concentrated, but also satisfy the stock exchange rules.
What strategic moves could you anticipate from them? Maybe another share issue, but structured differently. Or perhaps encouraging the major shareholder to sell down slightly.
Could be options, or maybe they'll seek an exemption, though that's often difficult.
And how might this tension, this pull between growth and regulatory compliance, how might that influence the company's future financial performance? Or even just investor sentiment towards the stock?
Definitely something to chew on. A fascinating dynamic to watch.